Welcome to A Voice from the Hills. I'm James Warner, co-founder of Silicon Hills Wealth Management here in Austin, Texas. Our special guest on today's podcast is Shana Sissel. Shana is the Director of Investments for Cope Corrales in DC. She's also a frequent guest on CNBC, Bloomberg, and the Fox Business Network. On her second day in the investment world, Shana found herself on the 64th floor of Tower 2 in the World Trade Center on, you guessed it, September 11th. Shana is definitely a survivor and truly a motivating and inspirational figure in our business. But our focus for today's podcast is really on her skill and expertise in developing and allocating investment portfolios during difficult environments. And we're going to turn that to a special focus on her work in the alternative investment space. Shana is a chartered alternative investment analyst and has spent a large portion of her career doing due diligence on managers and strategies within the space. As the environment for the traditional 60-40 portfolio becomes ever more challenging, the incorporation of alternative investments into a traditional portfolio becomes paramount for investors seeking some form of risk management along with growth. There's no better professional to walk us through the alternative space than Shana. So please join me in welcoming Shana Sissel.
James Warner is the founding partner of Silicon Hills Wealth Management and the host of A Voice from the Hills podcast. All opinions expressed by James, his co-host, and his guest are solely their own opinions and do not reflect the opinion of Silicon Hills Wealth Management. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Silicon Hills Wealth Management may maintain positions in securities discussed in this podcast.
Good afternoon, Shana, and thank you for joining us.
Thanks for having me.
Yeah, I've always wanted to have you on the podcast, but especially given the current market conditions. But before we get into and start talking about investments, let's talk a little bit about you. Share with our audience your background and kind of your career arc.
How long do we got?
Oh, we got plenty of time.
Yeah, it's a long story. So I want to make sure, I don't take up the whole podcast with my boring life story. I'm happy to tell you, where would you like me to start?
Well, let's start 2001. How about that?
All right. So after graduating from my undergrad at UMass Amherst, I took a job at a staffing agency. I actually have an undergraduate degree in sport management, and I really thought I was going to work in the sports industry. I wanted to be a sideline reporter for ESPN and had done an internship at the New England Sports Network at a time where Kara Henderson and Wendy Nix were the primary faces of Nesson at the time. And took a job at a staffing agency because there weren't a ton of opportunities for me to be doing sideline reporting in the Boston area. And I was kind of tied there because of a boy. And eventually ended up going and interviewing undercover at Morgan Stanley to be a financial advisor because the staffing agency had been hired by Morgan Stanley to find financial advisors, and we had sent probably 20 people and hadn't had any luck. So they asked me to go undercover to see if I could figure out what they were looking for. And I actually was offered the job. So that was how I got into the world.
So you did figure it out.
Yeah, apparently I interviewed well. And they offered me a whopping $31,000, $32,000. And at the time, that was a huge pay increase for me based on what I was making at the staffing agency. I didn't really think I was going to be pursuing a career in finance at the time. I just thought, well, this will allow me to move out of my parents' house. And so I took the job and ended up falling in love with the market. So fast forward, I decided to leave Morgan Stanley because as much as I enjoyed the markets, I didn't so much love being a financial advisor in that setting. So I went and got my MBA from Bentley University and then took a job at Fidelity Investments on their sales desk because despite the fact that I didn't really want to be in sales, it was the only thing I knew how to do. So I figured I'd get my foot in the door at a larger organization and then kind of find a way to get into a more analytical role, which is pretty much what I did. Eventually left Fidelity to join Russell Investments and work on a hedge fund to fund. And that's what introduced me to the alternatives world. And from then on, I've had a number of different stops. I worked for a small REA in Waltham, where I got into media there. We can talk about that if you want to go there at some point. Worked at Mercer Investments, helped launch an emerging market mutual fund, and helped manage an international equity fund for their outsourced CIO platform. Moved on to Fidelity Investment Strategic Advisors, similar role, but focusing more on US equity and value in particular. And then, the roles just keep coming. Worked at Ariel
Yeah.
Investments, Orion. I was CIO of a firm called Spotlight. Did some consulting for a little bit, helped launch an ETF called House, and finally landed where I am today at Cope Corrales as Director of Investments there in March of this year. So that is the Cliff Notes version of my career.
All right, so let's go back to 2001. So you're on day 2 of your class of your new class orientation at Morgan Stanley, right? And you happen to be
Yes.
on
Yeah.
the 64th floor of Tower 2
Yes.
of the World
So
Trade
that
Center.
is I kind of skipped over that, didn't I? It's kind of an impactful event. Yes. So Morgan Stanley at the time used to bring in classes of advisors. I'm sure some of the listeners out there might know this, but a lot of the large broker dealers, the Morgan Stanleys, the Merrill Lynches of the world, Smith Barneys, back in the day, would bring in advisors in monthly classes. So they would all start on the same time, and then they basically rank you and like call the herd every 6 months to a
Constantly
year.
call the herd, right?
Yeah. So you'd start off with like 350 people, and then by 2 years later, you'd have like 50 people left in the class. So
And Tower 2 was basically Morgan Stanley's
it
tower at that
was.
at that
So
time, right?
Morgan Stanley had most of the top, I think it was like 50 and above there.
Right.
So Morgan Stanley was the second largest tenant at the World Trade Center, and they had sent us there to do our training. So it was the second day I was there. Phil Roth had just finished speaking about bonds or technical analysis, can't remember at this point. So we had a little break, and I was kind of sitting there on the 64th floor of Tower 2. And we all know that that was a pretty impactful day if you were in the World Trade Center on 9/11 of 2001. And it very much was for me.
And so, I know you're fairly insulated. You probably didn't even hear the plane hit Tower 1, right? I mean that.
Well, we were in 64. It hit in the 90s. And while I didn't hear it, we did see debris. We did see things falling from the sky. I've told this story before. I do recall a Wall Street, not a Wall Street, a USA Today that was on fire flying by the window as I was
Oh
looking out
wow.
it. So these are little things, but we weren't entirely sure what was happening. As many people might know, is a famous documentary that the History Channel runs annually on the anniversary of 9/11 about a gentleman named Rick Rescola. The name of the
Oh
documentary
yeah.
is The Man Who Predicted 9/11. So because
And
Rescola,
Rick was with Morgan Stanley, right?
yeah, he was the head of security for Morgan Stanley. And because of some of the work that Rick did after Tower 1 was hit, Morgan Stanley insisted, even though the building did not, that we all evacuate. So Morgan Stanley lost 6 employees that day, which is, quite remarkable if you think about it, because they were the second largest tenant in the World Trade Center complex.
And
Um,
he was one of them, wasn't he?
it was him and his security team.
Yeah.
They went back up to help other folks that weren't Morgan Stanley employees get out of the building, and so he and 5 of his employees that worked directly for him were the people who perished, the only people who perished from Morgan Stanley that day.
So you're hearing the intercom saying, don't worry, go back to
Yeah.
your desk.
Yes, that's
And the Morgan
exactly.
Stanley people are saying, get the hell
Nope.
out of here.
Yes, absolutely.
And
Uh,
the actual second plane hit right on your floor, didn't it?
It did, but thankfully we had been evacuated, so
Oh my
it did
goodness.
go through basically the floor I was on. Um, and so very fortunate to have had Rick there that day, insisting everybody leave.
Gosh,
Wouldn't
yeah.
be
I
here without him.
I was I wasn't in the office that day. My son had been born 4 days earlier,
Hmm.
and I normally had 2 conference calls on that day. One with Cantor Fitzgerald,
Hmm.
on the bond side. And of
I
course,
think they
what
lost
happened with
everybody.
yeah, I mean, because I think they were 107th floor of Tower One. I mean, they were
Yeah,
just in, just
they
a,
had no way of getting out at that point.
yeah. And then David Alger,
Hmm.
uh, who was with Alger Funds, and David was just, I mean, you couldn't find a nicer guy. Those were the two that just kind of, you never really at that time. It wasn't like today where where you feel like somebody even if you haven't met them. I mean, it
Right.
was it was a little different, but still, it was.
I did.
Uh,
I did know somebody who was on Flight 11. My senior leader in high school was on that flight, um,
oh my goodness.
and so she unfortunately lost her life that day. It's interesting. You talk about my life story, and if you take out the finance part, the one thing that is a constant reoccurring theme is been exposed to traumatic events consistently throughout my life. My dad was a police officer and he was a corpsman in Vietnam. So he worked in the morgue when he was in the Navy. He assisted on autopsies in the Naval Hospital in Newport for some time after Vietnam. And then he became a police officer. And my dad never shies away from, horrific events. So as a child, if there was a car accident or some sort of accident or injury, and we drove by it, we would always pull over. My dad would always get out and help. Um, I had been to an event when I was about 7, a Polish festival in Worcester, Mass, which is where I'm from, with my grandparents. My dad happened to be one of the police officers working the event, and a gentleman went into cardiac arrest in front of me. My
Oh my
dad,
goodness.
tried to resuscitate him, and unfortunately, he wasn't unable to. We've had multiple situations in my family where my dad had to be part of very traumatic events. My brother-in-law's partner's son had an incident with a gun a couple of years ago. He was, I believe, 12. He found his father's service weapon and accidentally shot himself in the face
Oh my
and
goodness.
perished. So my life is full of a lot of trauma. For better or worse, it's hardened me and made me, resilient to handle pretty much anything life throws my
Well,
way.
and then you kind of found yourself. I guess you were a couple blocks away from the finish line at the Boston Marathon when the.
Yeah, it was lunchtime, and I was working at Fidelity at the time. I'd walked to grab some lunch, and I was in the downtown crossing area, so I was only a couple blocks away when that happened. And my brother-in-law was involved in the not the Waltham, the Watertown standoff because he is the head of SWAT and he was a trainer for Massachusetts um, Police Academy, and helps with that. So he was there. That was an interesting event that, and to some extent, wasn't as traumatic because I'd been in that situation before, so I felt more of a need to help others who were dealing with trauma for the first time. Yeah, so lots of traumatic events
Yeah, well,
been
no.
part of my life through the years. But I look at it as
I
not
guess
only,
market trauma kind of takes a real back seat to stuff like
yeah,
that. But
you don't get so emotional
let's
about stuff.
transition to some easier trauma and talk about
Yeah,
the market. So
let's talk about
let's do
something.
that. So we got supply chain issues, we got inflation, we got zero COVID policies in Asia. We've got the Fed that's looking to raise rates and kind of unwind their quantitative easing.
Mhm.
Uh, yeah, how do how and when should should investors be allocated their capital in this environment?
Well, it's funny. I'm sitting here in my hotel room at the Inside ETFs conference in Hollywood, Florida, right now, and sat on a panel earlier today talking about portfolio construction, asset allocation, and sort of how you should be positioning in this environment. And I would argue that 5 years ago, kind of what maybe not the supply chain stuff because the pandemic wasn't necessarily something that you could see coming, but the inflation, the Fed intervention in the markets, to some extent was a predictable outcome was going to be high inflation in an environment where bonds and stocks would both be doing poorly at the same time because you knew the Fed was going to have to raise rates, which would be a headwind for stocks and also a headwind for bonds. So at the time, I started talking about the importance of using alternatives in portfolios, looking at ways to further diversify across stocks and bonds, and talking about just the proliferation and the growth of this liquid alt segment, which became really something that developed after the SEC changed some of their rules that allowed for hedge fund like strategies to be implemented in mutual fund and ETF forms. So, right now, I really think that advisors and clients need to think about portfolios beyond what has been traditionally comfortable, which is stocks and bonds, and think about what is a little bit uncomfortable to people because it's a little more complex, which is using these uncorrelated asset classes as a way to manage risk. And now is the type of market where they really are making a huge difference because stocks and bonds aren't working. Cash isn't a great place to be because inflation's so high, you're not going to keep up. And you have to think about ultimately the market and equities are the place you want to have the majority of your assets over the long term because that's where you'll get your return. But how do you manage the risk in that area right now? And I would argue that using these types of vehicles and these types of strategies make a lot of sense because they continue to allow you to have the exposure that you need for long-term growth in your portfolio, but they help you manage the risk, especially at critical times like today.
So let's talk about alternatives. It's kind of hard to define what they are, maybe easier to find what they're not.
Steal my line.
But let's define alternatives and discuss what their place is inside a diversified portfolio.
So, as you said, it's easier to define what they're not than what they are. Basically, alternatives are anything that isn't long only equity, long only stocks, or long only bonds. So that can be a lot of things. That can be, hedge fund like strategies, long, short, market neutral, global macro. It can be managed futures and commodity type strategies. It can be private equity, although I would argue that some of the alternatives that can be uncorrelated, like private equity and private debt, aren't available to the average investor because they really can't be implemented in a form that can be broadly available to the public. So those kind of have to be in private funds, which have limited access just due to regulatory rules. So it's a lot of different things. You'll notice I didn't say real estate because unless we're talking private real estate, it's not a diversifier. REITs are equities. They trade in traditional markets, and that hence they trade like equities. So I don't consider REITs alternatives. I do consider private real estate and physical real estate an alternative. And I would throw crypto in there as well. Crypto to me is an alternative. It's an uncorrelated asset class. Gold, physical commodities also fall into that bucket as well. And the one thing they all have in common is that they do not have returns that mirror or correlate well with equity and fixed income. They can do well even when those things are doing poorly, and sometimes they do well even when those things are doing well. The key is to provide diversification by having that uncorrelated return stream to manage risk in your portfolio.
And do you think that systematically these types of assets tend to do better in an inflationary environment? Or I guess if we're comparing them to a traditional, high credit bond portfolio, I mean, I know if interest rates are going up that my bond portfolio is going to lose value.
It depends. I mean, it really depends. Do they do well in high inflation environments? Yeah, physical commodities do, managed futures do. Absolutely. They aren't necessarily something that you would expect to do well in a high inflation environment per se. I wouldn't say they're necessarily correlated to inflation with the exception of those commodities. They can do well, but there are other factors that play along. For example, a market neutral strategy will do well if volatility is high. Same thing with long short. Global macro really needs some sort of trend following aspect to it. Crypto has its own set of rules. They tend to be a risk asset. So when risk is on and you have some speculation in the market, they tend to do really, really well. They can really juice your portfolio even with only like a 1% allocation. So they all play a different role. And I wouldn't necessarily say, oh, they do really well in an inflation environment. What they do is they do really well under certain circumstances. And right now, the circumstance we're currently in, which isn't just high inflation, but it's rising rates and slowing economic growth, those three things bode well for these types of products.
And then if you were to compare, kind of the traditional 60/40 portfolio that might have been in vogue and actually something you could put into practice 10 or 12 years ago.
Mm-hmm.
If somebody's, they're entering retirement, they've got a nest egg that's sufficient enough to cover their retirement. Mm-hmm. They would traditionally go into that 60/40 kind of portfolio setting. What do they have to do today?
I kind of consider it like the evolution of the 60/40. So I can tell you what we do, and this is what I suggest. I look at a portfolio, and if I have a client come in and has $1 million, let's say, in the scenario you're talking about, and we're going to put them in a 60/40 kind of portfolio, we're going to take 800,000 and we're going to put that in a very traditional 60/40. Like, I'm not going to do the math in my head. That's what we do. And then we take the remaining 200,000 and we put that in our alts portfolio. So it's kind of a core satellite approach. But one of the reasons why we do it that way, and I explain it that way, is because we don't have this conversation of, where do I take my 20% of? Do I take it from equity or do I take it from fixed income? I take it from both. And the easiest way to do that is to just say, if you have $1 million with us, 20% is going in alternatives, and then the remaining will go into what would have been considered the traditional 60/40 of 60% stocks, 40% bonds. What it ends up being is something like 52.5% equity and 25-30% fixed income, and then the remaining ends up being split in alternatives. I like to do a diversified mix of alternatives. Right now it's a 5-5-5 5 20%. I don't attempt to like tactically weight those the way I might do in an equity or fixed income portfolio. But the key is to choose 4 alternative products that are uncorrelated with each other, as well as with traditional markets. So there's a number of ways you can do that. It helps if you understand, or if you have a background in hedge funds, because you know all the different types of strategies that can be implemented. What they all have in common is they all hedge something in some way, because they can all go short. And so unfortunately, there's not really good resources for the average person to go and look for liquid alts, because they're not really categorized well. Anybody who's ever used Morningstar to try to find a liquid alt, now to Morningstar's credit, they have developed categories that would traditionally be liquid alt. Problem is, they still don't really do a good job defining it. I joke that I was looking for a global macro fund, and for anybody who doesn't know, global macro is a very common strategy that's been used with hedge funds for years. Essentially, what they do is look at these big macroeconomic trends, and they attempt to use a wide variety of financial instruments to take advantage of trends by going long and short. And they'll use currencies, commodities, futures, stocks, bonds, whatever, to gain that exposure. And they tend to do really well in markets like today. They crushed it during the financial crisis, and they're crushing it right now. But if you try to go find a global macro fund in Morningstar right now, like, you could look under macro. They have a macro category, but you'll also find global macro strategies in tactical allocation and global allocation. You will find them in options trading, options-based strategies. That's another one that they call multi-strat. Will have some global macro in there. So it's not like you can just go to the macro category and find macro funds, because I can name you a bunch of different, like the Chiron allocation fund. That's what it's called. Is in the world or global allocation category by
like
Morningstar.
global or
It
world
is
allocation, one
very
or the
much,
other.
it is very much a global macro fund. The Ivy strategy, I'm trying to, Ivy Macro Strategy Fund is very famous, one of the first global macro mutual funds that ever existed. I believe that one is in the tactical allocations bucket. It's not in global macro. So it doesn't make it easy for the average person to try to find these strategies. You kind of have to know the landscape and then kind of know what you're looking for, unfortunately.
Well, I think even for the smaller advisory firm who realizes that, if the 60/40 portfolio isn't dead, it's
It's on life
certainly
support.
it's certainly in waiting for a more favorable interest rate environment or scenario to be more effective.
Mm-hmm.
Your background is in analyzing different managers and different alternative strategies and deciding what due diligence needs to be undertaken there, and how do you compare those two. How would you talk to the registered investment advisor with a fairly small book of business? Maybe it's 100 million,
Mm-hmm.
and they've got a lot of 60/40 candidates in their mix, and they realize that some sort of alternative exposure really is going to be necessary for them to manage risk into the future so that they can maximize their equity allocation. How would you have them get started? How would they do the due diligence
I,
on
I
those
have to
sorts of
say
things?
it's difficult, and in the alternative space, I recommend working with somebody who has expertise. Now, sometimes you can have that inside your firm. Obviously, I'm somebody who's worked for several firms, and I have quite a bit of expertise here. But ultimately, I think this is a place where you do actually want to reach out to model providers, and there are several out there that do. Alternative models that do the work for you, and they all have a different approach. Corey Hofstein firm does a great job with this. John Davey, Astoria Advisors, is another one that does great work and has some alts product. Wisdom Tree has some alts products, but you almost have to work with a firm like that because there are idiosyncrasies here. A perfect example of this, and I'm not going to call out the firm because I think it's inappropriate, but I do think it's important to kind of point these things out. For example, there are products on the market today, buffer products, tail risk products, options-based strategies that purport to provide downside protection if the markets go awry. There's one very large one, well-known tail risk product that has marketed itself as a risk hedge and risk management. That product is specifically designed and has marketed itself as a hedge in case the markets blow up. Well, that product is down the same as the markets right now. So these strategies, you need to know more than what the marketing team is telling you. You really have to understand how these strategies work under certain stress situations. It's critical because there's a million different ways to implement option-based hedge strategies. And if the way you're doing that is writing leaps, but you have to provide treasuries as your collateral for your leaps, and the treasuries are going down just as much, then it's not much protection. And the same thing with buffer products. These buffer products are at their core an options contract and a treasury that's paired with it to meet a certain yield requirement. And there are going to be situations like the one we're in now where the treasury that you've paired in here and the option that you have are not behaving in the way that you would necessarily expect, and so they can't necessarily provide the buffer that they promise. And so it does take some expertise in understanding these complexities of these underlying strategies to be able to really pick the right ones. And I
Yeah, I
don't
think
think
for
everybody
the
can do
most part, I think it's really hard for the average person to understand the concept of the decaying value of an option.
that.
I
Absolutely.
I
Absolutely.
think they just don't get it.
Knowing your Greeks is, even I get confused by the Greeks. Somebody starts talking about Vega and theta, and you've lost me. And I understand options pretty well, and I understand how these option-based strategies happen, but it is very complex. And I do think this is an area where it helps to have a partner that you can work with that has expertise.
And there's lots of different strategies that pretend to be market neutral. I see that name listed, in many different,
And
facets,
that can
right?
mean a bunch of things.
And so, to me, at the worst case scenario, market neutral means I do a lot of, crazy things and end up earning zero.
Right.
But what do you look for when you see a market neutral market neutral fund? What do you kind of look at and go, okay, well, how do I compare this market neutral fund with another market neutral fund? Or because the name doesn't necessarily pretend what it actually does.
So the goal of a market neutral fund is, quite frankly, at its foundation, to have equal amounts of long and short exposure so that your beta is zero. So that means you should have exactly the same amount of long exposure as you have short exposure. And where that is just the basics. But where it gets more complex is, what are you long and short, right? Because that matters. And in a market neutral strategy, you don't need either side to be positive. You just need the side that you are long to be
more positive than the other side,
to be down less than the other side, because then you're net positive. So if you're long a stock that's down 1% and you're short a stock that's down 3%, then you're up 2. That's just how it works. That's basic. That's probably making it overly simplistic, but yeah, there are market neutral strategies that will perform very differently at different times. So I think anybody who's seen me speak knows that I talk about a specific fund called the AGFIQ US Market Neutral Anti-Beta Fund a lot. It's my favorite market neutral fund. The reason I like it is because if you believe that low volatility stocks, and there's some research here that's supports this, will outperform high volatility stocks most of the time, then a strategy like BTAL will do really well, with the exception of those periods of time where that relationship doesn't work. Because BTAL goes long stocks that have low beta and low volatility, and shorts high beta, high volatility stocks. And so as long as low volatility is doing well and high volatility is doing poorly, the fund will do really well. So for example, it tends to do well when markets decline heavily, because high beta stocks do worse, even if the low beta stocks are also down. It also does well in periods like 2018 and 19, where you had oil and energy stocks, which were super high beta, really doing poorly compared to tech stocks, which ironically enough were the low beta.
Were the low beta then, yeah.
Were the low beta names back then. And so it did really well in 18, 19. It did well into 2020. And then in June 2020, you saw, maybe it wasn't June 2020, it was June 2020. Yeah, it was June 2020.
It was right after COVID. I know exactly.
Yeah, but there was a point in time where the relationship between growth and value changed. And you started to see small caps and energy stocks start to rotate and outperform. And when that happened, the fund got killed. But then the relationship between what stocks were high beta and low beta also changed after about 6 months. And now, even though energy stocks are still outperforming, they now have lower beta than the tech stocks. And so now BTAL is actually doing quite well. I think last I checked, and it's been a day or two, it was up like 15%. But the market's also super volatile, so that's helped as well. So there will be periods of time it doesn't do well. So when you look at a market neutral fund, you want to understand what it is they're buying and what it is they're selling, going long and short, and then understanding and figuring out if you think that relationship, if the stuff that they're buying will do better than the stuff that they're selling. And there's so many different ways to implement that. You could do it.
And also how it relates to the equity portfolio that you bring to the table as well, right? So
exactly.
I mean, if you bring to the table an equity portfolio with a lot of high beta names, then something like this might have much better correlation coefficient. It might have a much better hedging it might provide a much better hedging environment for a portfolio of high beta, high growth names than it would for low beta value names, right? So you
Exactly.
have to kind of know what it is you're bringing to the party before you pick your hedge, right?
Yeah, and there are other ways to implement market neutral. Sometimes it'll be based on valuation. There is a fund out there that's market neutral valuation, so short high PE stocks and long low PE stocks. That didn't work really well for a long time. When you had tech outperforming. So, for example, BTAL did well in 1819. A strategy that was market neutral based on valuation would have done completely horrible, yet they're both market neutral. They just have to understand how the strategy is being implemented. And really, that is the difficulty of doing these alternatives, whether it be in a hedge fund, an interval fund, a liquid alternative fund. When you're dealing with these types of very different implementations of investment strategies, when you're doing any sort of hedge strategy, how you're doing it and how you're implementing it really matters. Not every market neutral fund is alike. Not every long short fund is alike. You could be long short. It just like not all equity funds are alike. Value, growth, small cap, mid cap. You have to understand the underlying way that they're implementing those strategies to determine whether or not it will outperform. So it's not as easy as just going and looking at all the market neutral funds and figuring out which one's 5-star and had the best track record the last 3 years, because what worked 3 years ago in a market neutral strategy might not work today.
That's right. It's got to fit with what you have as well, because
Mm-hmm.
you don't want to hedge. If you end up hedging the wrong thing, you don't even have a hedge. You just have
Right.
more of the same, right?
Yes. And a
Let,
lot
let's talk
of
about
people run
let's
into
talk
that.
about managed futures, because that's
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 another
certainly a
one.
strategy that's done well, at least lately.
Yes.
Um, how would you define a managed future strategy to the audience, and how would you go about comparing two different managed future structures or two different managed futures investments between one another?
So managed futures are literally what it is. It says it is. Futures contracts are derivatives where you're looking at exposure of any asset. You can do it on the S&P. You can do it on, you know, commodities. You can do it on fixed income. You can buy futures contracts for all of those things. Where basically you're buying the future value and you're gaining exposure to something for a notional amount of money, like any derivative. Um, Managed futures products are most often used in commodity space. So most managed future products that you see there are using commodity futures, which is really the only way to gain exposure to um, directly to commodities, not the equity, the companies, the stocks of companies that play
Not
in
the
that.
operating company that
Yeah.
actually.
So if you want to have exposure to oil, you're not buying the spot contracts because you're not going to take delivery of oil anytime soon. Um,
Well,
you're
in
going to buy
Texas, sometimes in
maybe.
Texas there are a couple of people who think they can, but other than that, yeah, you're
But
right.
when people talk about like what oil's doing and what corn is doing and what pork is doing, they're talking about future contracts. They're not talking about like the actual underlying commodity. Um, because futures contracts are the way you gain that exposure. So most managed future strategies are giving you exposure to commodities. Right now, they're doing really well because it's very high inflation environment, and then you have supply chain as well as weather disruptions that are affecting your ability to, just from a supply demand standpoint, that's such a huge component of commodities in general. So managed futures are using futures contracts to gain that exposure and then using trend following. Usually some use other methods, but trend following is the most common to take advantage of supply demand dynamics in certain commodity markets or all commodity markets. So the strategy we use right now is actually only long and does trend following across all the major commodity buckets. So that's metals, that's oil and gas, that's agricultural commodities, it's gold, silver, that kind of thing as well. So it's done really, really well because we're in a super high inflation environment. There's a lot of disruption on the supply chain for these things. So prices have gone up. Managed futures contracts and managed futures strategies really take advantage of that. And they can also, like we just talked about, be implemented in a variety of different ways. So how you gain exposure to managed futures matters. They are managed by what are called commodity trade CTAs, commodity trade advisors.
Advisors, yeah.
So they are specific registration. They have their own regulatory function. And managed futures products are always managed by CTAs. So sometimes you'll hear people refer to it as a CTA fund and not a managed futures fund. They're interchangeable terms for the same thing.
Yeah. And then in terms of location of the assets, I'm sure that in some cases having it in a qualified or tax deferred environment, because of the taxable nature and the frequent rebalancing that might have to occur in alts. Do you see people doing that? Do you see people maintaining a household level of the 20% alts, but actually moving the alts or allocating a heavier percentage of the alts to their qualified plans or their tax deferred plans? Or do you see them just allocating it irrespective of tax location?
I would say I see it mostly irrespective of tax location for two reasons. You can do this in ETFs, and so then the taxable impact is only on the buy and sale of the ETF itself. And you can buy it in mutual funds, which again, many of them are managed in a way to try to make them more tax efficient. And some of these products have embedded capital losses for years of not doing nearly as well as the market that can be taken advantage of. So, these products are not necessarily tax inefficient. That's the word I was looking for, per se. It gets a little more complicated if you start talking about going in a private fund or an interval fund where you're talking about K1s and it gets way more complex. But in a traditional 40 Act product like an ETF or mutual fund, I would argue that there aren't any more or less tax inefficient than any other product in that. And if you do it in an ETF, then you're really looking at the taxable event only happening on the buy and sale of the ETF and not any of the underlying activity that happens in the management of the fund.
Yeah, well, and certainly a taxable bond is not exactly the most tax efficient instrument known to man either. So,
and I would argue sometimes if you're that concerned about taxes, then you might take a different approach to your portfolio construction. But I would argue that these types of products play a role and are not going to inherently be less tax efficient for your portfolio. And in fact, they're going to manage your risk in a way that could probably even out the overall taxable events in your portfolio in a lot of ways. The bigger concern with these products is expenses. That comes up a lot more than tax.
Yeah, it's the expenses, and it's being able to understand that just because something has the same name doesn't mean it's the same.
Yeah,
concept.
people I think pay a lot of attention to the expense ratios for these products, and there's two really important things that I like to remind people of because I think it's important when you have this conversation. Number one, anytime you're shorting anything or playing in the space of derivatives, you're talking about having to use leverage to some extent, which requires margin, which requires a cost. There's an interest rate that's involved. So that inherently makes these strategies slightly more expensive to do and to implement. The second thing, which is probably not as well known, is that the SEC and the regulators actually require that the calculation of the expense ratio not include rebates, which is actually an important part of these strategies because there's rebate on margin and there's rebate on a number of different aspects of shorting, meaning that the expense of the short, you get the rebate for the dividend, you have to pay the dividend. These types of things are components that help manage the cost. But the SEC does not allow for the rebates to be calculated as part of the cost of the fund. So the expense ratio that you see is actually not reflective of the actual cost of the strategy, and there's no way around it. This is how it's required to be calculated. It is not actually a proper calculation for the cost of implementation of the strategy. It will always look more expensive. But unless you know that, you're going to look at something with a 2% expense ratio and think that it's really 2%, but in actuality, it's probably never 2%. It's just they're not allowed to calculate the rebate.
Yeah, they just treat the expenses as permanent and the rebates as temporary. And
yes.
Yeah.
And so it's never included in the calculation of the expense ratio. But the rebates is part of the strategy implementation, and it will have, and they will, it's not like they will never be there. The amount may change from time to time, but they are always part of the strategy, and quite frankly, I think should be reflected in the expense ratio. I think the regulators would argue that because it's super volatile and inconsistent in how much that rebate will be month to month or year to year, it makes the expense ratio much more volatile in its calculation. So they just don't allow it, and so all these strategies look super expensive when in actuality they really aren't.
And so I think we're both on the same page on alternatives. We definitely need them, and you need to take a lot of care in evaluating what the specific alternative is, how that allocation is, and actually what you're trying to hedge, what kind of portfolio you're bringing into it. Let's talk about the other part of the portfolio. Let's talk about the equities. We talked about all the challenges in the market. Well, not all of them. We didn't talk about geopolitical concerns, which are obviously there.
I always
did,
joke though, the geopolitical stuff, you can be concerned about that, but if the worst case scenario on the geopolitical front happens ever, like the last thing you need to worry about is what your stocks are doing.
Yeah, then we're all fighting for
we're all
for a
screwed.
chicken in the middle of the street.
Yeah,
So,
that's a scenario where like it really doesn't matter.
Yeah, my grandmother always told me never plan for the end of the world because it's only going to happen once.
Yeah,
So,
and it doesn't matter how your portfolio is allocated at that point.
it'll be like that USA Today that's kind of flying in front of the
front
of the window in Tower 2, right? It won't have much meaning. But let's assume the worst case doesn't happen. We've got equity portfolios. We've obviously had a drawdown in equities. We've had a correction on the equity markets.
Mm-hmm.
Where do you think we are? Is now are we approaching fair value? Are we still above fair value? Where do you think we're at?
So the general rule of thumb, and this is such an easy way to think about it, I like to just start with the rule of 20, right? So for anyone who's not familiar with the rule of 20, super basic calculation you can do in your head to just start this process. And the rule of 20 says you look at the PE of your market and then you add inflation. And if it's over 20, it's overvalued. And if it's under 20, it's undervalued. And it's super easy. On average, the market sits around 20. So right now, even though we've seen a correction in the markets, we're still sitting at an S&P PE of probably like 19, 20, I think, on a forward-looking basis. And then when you add in inflation, which is at, let's say, 7, you're at 27. So I would argue that the markets are overvalued. Now, there's some additional research that says that bear markets and drawdowns tend to end when the underlying S&P hits 16 as a valuation. If you believe that, we're still overvalued because we're at like 19, 20. Sometimes it overcorrects, but 16 is kind of the number. So I would argue that there's still downside in this market, substantial downside. When we hit bottom, though, is anyone's guess. So I don't try to figure it out. I just say, I'm going to look for opportunities to buy when the market starts to sell off. And that is my main focus when it comes to equities is, I don't necessarily invest in individual securities, although my firm does have an internal hedge fund where we do. But I want to buy stocks when they're cheap. And so I'm looking for opportunities. One of the places that was a good place to be adding to in the last month or two has been small caps because they did actually hit those numbers. And they've started to actually do quite well. So these are just things you have to consider. There's technical factors, whatever. I look at it as like the rule of 20. Are we overvalued? Are we above 16? Those two things are both true. Do we have a number of factors that are going to make it hard for me to envision us getting to 16 or under 20 anytime soon? Yes, I think the market still has to go down. And I think that that's inevitably what's going to happen.
Well, and it's a tough market for people because, we've had several, certainly we have almost annually, we have a period where the market draws down, 10%, the stock market at least.
We hadn't, though, in a long time. I remember a year ago.
Yeah, since really since, we had the COVID.
We had the COVID drawdown,
but then
we didn't have a correction after that for almost 2 years. And normally you do have a 5 to 10% correction that occurs, once a year. And we didn't have that.
It's been typically unusual, I guess, that we would have equities and bonds correcting at the same time, or at least, the high credit quality bonds correcting at the same time, which you kind of hinted at the beginning of the podcast. And I think that, if you've got 100% long portfolio or predominantly long portfolio, you know what you're getting into. You know what the volatility is going to be. It's going to, you're playing for long-term growth, but you're understanding that there's going to be volatility. I think when you're using that fixed income as your hedge against your equities, and the hedge doesn't hedge, that's a difficult period for people. And I think they're working through that and starting to think, well, is this an anomaly? It's
not unprecedented. It's not. If you look at late 90s, it happened. Right going into the financial crisis, it happened. It was shorter stints. And because interest rates were never trending upwards, or there was no risk of them trending upwards at the time, it didn't persist very long. But this is not something that never happens. The problem is that it's hard to determine when the relationship will correct back to its normal, to the normal way they behave, because we are in an environment that I would argue the greater majority of people in this business have not been exposed to, which is a rising rate environment. There has not been a rising rate environment since the 70s.
Right.
And so most people have no experience in a rising rate environment, and a rising rate environment is bad for bonds. It's not always bad for stocks, but it is always bad for bonds.
Well, I think that's a great way to end it. That you couldn't say it any better. So, Shana, thank you so much for joining us. I hope you enjoy the conference there in Florida. Thank you for taking the time to join us on the pod, and look forward to catching up with you soon.
Absolutely. It was my pleasure. Thank you.
Thank you. And that's going to do it for our podcast with Shana or Sissel. I hope you enjoyed the discussion on alternative investments and how they might fit into an overall portfolio, how to differentiate between different types of alternative investments, what kind of due diligence goes into that space, et cetera. So I think Shana did a really good job of presenting what can be a difficult topic to discuss in a short time period. If you have some more questions about alternative investments or how they might fit into your portfolio, please give us a shout. We'd be happy to answer those unique questions that you have. Once again, thanks for engaging with us. If you'd like to know a little bit or learn a little bit more about Shana, you can actually go to her personal website. She also has a link tree that does a really good job of cataloging all of her appearances and written content, etc. You can also catch her on CNBC Overtime. You can catch her throughout the day on Bloomberg and occasionally on the Fox Business Network. Again, we'd like to thank you so much for engaging with us, and remind you can follow us and subscribe to us on any of the major podcast platforms, whether it's Spotify, Apple Podcasts, what have you. If you have a chance to subscribe and to rate and review the podcast, that'd be super helpful to us, and we would really appreciate it. But most of all, thanks for engaging and listening with us, because we can only do our best work when you are here to listen. Thank you.